This is Saturday, September 6th, and I'm going to give you the highlights of the most important news that has affected the stock market and will continue to affect the stock market in the coming weeks. I'm also going to give you dates to look forward to because we have some big ones in September. First, I've been glad that I've been buying the dip on Google or Alphabet, and I've been telling you that it's been undervalued all year. On September 3rd and 4th, a US federal judge issued a landmark ruling in Google's antitrust case. The judge affirmed that Google held monopoly power in search, but he opted not to enforce drastic remedies like forcing a breakup or requiring the sale of Chrome or Android. Instead, the judge imposed lighter measures, such as banning certain exclusive agreements and mandating limited data sharing, recognizing the disruptive role of generative AI in reshaping competition. This outcome was seen as a major win for Google. The company avoided the most extreme enforcement options, fueling investor relief and confidence. Following the ruling, Alphabet stock soared. Price spiked by roughly 9%, pushing shares to all-time highs around $230 to $232, translating into a staggering $200 to $230 billion increase in market capitalization. Also following the ruling, several analysts upgrade their outlooks on Alphabet, lifting price targets significantly. For example, Pivotal Research raised its target to $300. Oppenheimer maintained an outperform, and JP Morgan raised its target to $260, all signaling continued bullish sentiment. I've been buying since the $150 range last year and very heavily in the $160 and $170 range all year this year, so I'm very happy right now. I do believe that this stock will just continue to run. Now, obviously investing right now at its all-time high might be a little bit risky, but I do think that long term, I agree. I think that I see it over $300 for sure in the next couple of years. Now each week I answer a question from you down in the comments section, so let me go ahead and answer last week's question and then we'll get into the news for this week. Professor Nolan, love your videos. Please make more about individuals, stock, and crypto. Since young people also watch your channel, maybe along with your 3-fund ETFs, we youngsters can go for individual stocks too. Okay, that wasn't a question, and I will answer a question in a second, but first let me touch on this. I literally teach finance and investing to 18 to 22-year-olds at the university. Why do they all think that ETFs and index investing is for old people or just for retirement accounts? Younger people, please listen up. I don't say many things with conviction or absolutely tell people exactly what to do because 1, I don't want to get sued, and 2, I do want people to do their research. But everyone, please know that I've done over 20 years of research. I've met with over 1,000 clients who have anywhere from tens of thousands of dollars to have tens of millions of dollars. And all of my research, plus all of my time with these multimillionaires, plus all of just my own investing, all point to this fact that investing in ETFs and index funds and mutual funds that have low fees and have broad exposure to the overall US market is just the way to go for long-term actual wealth building. Some individual stocks might pop off, but there's a bunch of them that you're actually going to either lose money or they're going to stagnate for a while, and it's going to be tough for you to psychologically actually sell out of them, and you won't really know when to do so, while all along the S&P 500 will just keep trucking away. I never waver on this opinion. I think that most people should just be invested in 90% or more of their portfolio in solid ETFs. You could have about 10% in individual stocks, but honestly, the less individual stocks you have in the portfolio, the more simple it is and the less anxiety you're going to have. Do your own research, and this is not financial advice, but I believe it and have seen it in every way possible. Okay, so the actual question this week. If there's a dip, should we use some percentage of a 6-month emergency fund to buy low, then rebuild the emergency fund instead of putting new money into the market? Okay, make sure you don't get this wrong. But first, I want to thank and introduce the sponsor of this video, Delete Me. Did you know that your personal data is sold online by data brokers? You have the right to stay private and protect your personal data. Delete Me is a hands-free subscription service that will remove your personal information that's being sold online. Right now, it's becoming all too common of this trend of data breaches resulting in the loss of personal data control. 1/3 of the US population's background info is now public. Delete Me's privacy experts remove your personal information such as phone number, address, and other important information from hundreds of data brokers all year long. I really enjoy that customers can make custom removal requests. We all do a lot online, especially with investing, so it's just a smart move to have an extra layer of protection. Get 20% off Delete Me US consumer plans when you go down to the link in my description, which is joindeleteme.com/professor, and use code PROFESSOR at checkout. Okay, so if there's a dip, should we use the emergency fund? Short answer, no. If we experience a true dip, like something like 15–20%, we're probably in some sort of recession, and a recession could last multiple years. And depending on the type of recession that we're in, people are probably losing jobs. So let's say worst case scenario, you take a huge chunk, if not all of your emergency fund, throw it into this dip, and then a week or two later, maybe you lose your job. And now you have no income coming in and you have no emergency fund. That's an absolutely terrible place to be. At that point, maybe the stock market's dropped a little bit further from when you put that money in, but now you have no money, so now you have to pull that money out and you just lost money by doing that. Emergency fund is literally for emergency, not for dip buying. Now I know that in the question you said a percentage of the emergency fund, and honestly that part just depends. Let's say that you have a year's worth of living expenses there and you can probably get a job within 3 months, maybe 6 months. So you just use maybe 1 month's worth of living expenses to buy the dip. That's not the craziest thing in the world. But let's say you have 3 months worth in your emergency fund and you use half of that or something. That only gives you a month and a half to find a job, and in a tough job market or a tough time like a recession, it usually takes people 6 months, maybe a year to find a job. For those of you that haven't lived through one of these, ask somebody older who has lived through something like that. Your emergency fund should be your emergency fund, but once you fund that up, you can have another savings account or even use the money market within your brokerage and have some money stashed there. What I do personally is I have my emergency fund fully funded, and so I put a portion, like 10% of my investable amount of money, into the money market within the brokerage account. It's earning interest, and I just have that there in case of a big dip. If something goes down 5%, 10%, I put a portion of that money, if not all of that money, into the market at that point, but my emergency fund stays my emergency fund. Good question, and I know a lot of you can benefit from that answer. Okay, so now on to the news. The biggest thing coming up in September is obviously the Fed rate discussion and if we are going to see a Fed rate cut or not. Take a look at the table I made here for the most important dates in September. September packs a dense schedule of influential economic and political events, from jobs and inflation data to Fed policy and political risk. Markets are expected to remain highly reactive, especially to labor data and FOMC decisions. Some of these big ones to highlight would obviously be that September 16th and 17th FOMC meeting and policy decision. This is where we're going to see if we actually have a rate cut or not. Also, that third Friday, mid-September there, the S&P 500 is going to have a quarterly rebalance, so we're going to see the different shifts there. And one of the biggest things on this list already happened, which was yesterday, with a bunch of data showing some negative things in our economy. The August jobs report saw the U.S. economy add 22,000 jobs on the month, the Bureau of Labor Statistics reported Friday. That's below the 75,000 that economists polled by Dow Jones had expected. The unemployment rate also rose to 4.3%, in line with expectations. Traders are hoping the reading will lend support to the Fed's case to go ahead with an expected rate cut at its September policy meeting. Fed funds futures trading suggests that benchmark interest rates will likely move a 0.25 percentage point lower when the central bank makes a decision on September 17th, according to the CME Group's FedWatch tool. Not only that, if you look here, traders put a half-point cut in play for mid-month following the payrolls data. That's up from a 0 chance of a supersized cut the day before. This week was defined by market euphoria on easing monetary policy expectations, driven by weak labor data and relief on the regulatory front, particularly for tech. Big tech stocks led the charge higher, but investors remain watchful of inflation prints, central bank signals, and geopolitical or fiscal policy surprises. It does look like the stock market is starting to take a shift, and the shift from growth to value/safety is definitely something to start keeping an eye on. A mix of bond market trends created what analysts call a tale of two bond markets. While the 2-year yield dipped below its 200-day average, The 30-year yield remained elevated amid inflation and fiscal concerns. Bond ETFs saw record inflows of about $49 billion in August. Long-term treasury yields have been moving higher, adding a level of vulnerability to elevated stock valuations. You have to know that the stock market is crazy high valued at this point. Almost everything is at all-time highs, and most stocks have a crazy PE ratio and very crazy PEG ratio. Things are overvalued at this point with a lot of hype, specifically in AI and technology. The hype can definitely be realized down the road, but we have to call it what it is. Right now, things are overvalued. In a video I put out last week, I showed the data that September is historically a bad month for the stock market, so just be aware of that and of the Fed meeting coming mid-month. I'm continuing to dollar cost average in my 3-fund portfolio just as usual, but if any big dips do come, I'm going to be ready to pounce on them. Watch this video on how you need $500,000 or less to actually live off of passive income forever. I break it down with the actual portfolio with actual funds and actual numbers so you can see exactly how a lot of my clients are doing this with less than $500,000. Or watch this one to keep you going strong in investing. Remember to keep investing simplified.